Today's podcast is with Thomas Mattimore and James Glasscock, the head of protocol and head of ecosystem at Reserve. Reserve Protocol is an ecosystem to allow developers to create new stablecoin projects. We discussed a few of the projects that have launched using Reserve so far, the history of the company and the protocol, and we discussed what a stablecoin is, what it might be in the future, some pros and cons or attributes of USDT, Tether, and USDC that are concerning, and how the recent SVB banking crisis has played into the need to have more secure, transparent stablecoin projects out there, and why Reserve is such an important project to help people do that. Hope you enjoyed this conversation as much as I did. If you do, please give the show a thumbs up, share wherever you listen to it. And without further ado, here is Thomas and James. All right, so James, Thomas, I'm excited to be chatting with both of you guys from Reserve. Maybe just kick it off with your backgrounds, how you guys met, and why you both realized that this is what you want to spend the next 5-10 years of your life plus doing. Maybe I'll point it to Thomas, if you want to just jump in there.
Yeah, sure. Thanks for having us on, Mike. Our mission at Reserve is to fight inflation and help expand access to stable currency around the world. I joined a year ago to help lead the protocol team. And, before that, backing way up, I've been in product and fintech for the last 10 years. Throughout that time, I was keeping up with crypto the whole time, but it was always a side hobby. For the most part, I've always been focused on giving people access to financial products that they didn't have access to, whether that was better investing products or lower cost, faster, more efficient mortgages or whatever that was. And, crypto was always a side hobby. And then in 2020, I used MakerDAO for the first time and my mind was blown. I was working in consumer lending and then all of a sudden I got, like a sizable loan in a couple clicks in a couple minutes. And I was like, oh wait, DeFi's here. This is a real thing. It's actually it's possible. It's cheap. It's easy. This is amazing. And so I started to figure out where do I want to dive in? Where do I think I can actually build something that people will actually need and use in crypto? And so I started looking around and there was a couple things that I focused on. One is what is product market fit now in crypto? And to me, it's stablecoins. And, it's really the biggest use case of crypto that has gained adoption outside of speculation. Secondarily is where are people using this, right? And it's really outside of the US. People oftentimes forget in the US, we have pretty good financial services. Our banks, we aren't worried about the money going away until recently. We have Venmo, we can easily send our friends money, you can use a credit card wherever, it's not a big deal. And so, but outside of the US, that's not the case. In Colombia, it's illegal to hold dollars in a bank account. In Venezuela and Argentina, where the government's going to take your money. There's a lot that people take for granted in the US. And then the third thing that I was looking for is I really wanted to work on a core DeFi protocol. And, I've learned about a lot of different types of technology over the years, building products in the Web2 space. And to me, Solidity, DeFi is really the big thing that I was interested in wanting to learn about. And so, I ended up getting connected with Nevin, the founder of the overall Reserve project. And we got to know the team, and it's a really special group of folks. And so I joined to lead the protocol team actually almost exactly a year ago. And it's been a really exciting time. We can go way more into it. And I'll hand it off to James, who I was happy enough to meet along the way.
Yeah, thank you.
Hey, Mike. Thanks for having me. I'm James, head of ecosystem at Reserve. I spent about the last 20 years building media companies, places you've heard of, Warner Brothers, Turner Broadcasting, several other businesses, growing their strategy and operations departments. And I started dabbling in crypto in 2013, and I started investing in it in 2017. So my journey with Reserve has actually been a long one. I was a seed investor in Reserve back in 2018. People often ask me, well, why did you invest? And, 2018 was an unusual moment in time where there were a lot of really bad projects out there, bad players out there. And when I met Nevin, although I barely understood what was in the white paper, this was I felt completely different, and I usually, when I invest in projects, I start with the team first. So I had a really good feeling about him and the mission that the team were on. And increasingly over the last 5 years, as I've been involved in a number of Web2 startups and other types of companies, I started to develop a thesis around stablecoins, which is these stablecoins in DeFi, especially in 2017, 2018, lots of folks were looking around at, decentralized Uber, decentralized Airbnb, all the things. And what I started to really notice is DeFi is where the most innovation was going to happen first in crypto, because there's a lot of money at stake. And it's actually less about a, one-click service and convenience, and more about, people are sometimes making 5 figures, 6 figures, 7 figures, maybe more. And so people are kind of willing to compromise UX a little bit more on DeFi, although I hope that doesn't last for much longer. And then more specifically, and today DeFi is about $50 or $60 billion staked. It's easily the largest, outside of stablecoins specifically, the largest sort of pool of activity within crypto. But what's interesting about stablecoins, and there's so many different designs and models for them, it just struck me as a really interesting place to be on the cusp of all innovation in DeFi and crypto, thinking that things that we're doing right now in DeFi and stablecoin specifically will get utilized in e-commerce and streaming and all of the other really cool applications we're all hoping to see over the next decade. So yeah, my role at Reserve is I support Thomas. We're building a community and an ecosystem. Our developer relations, business development, and community, those the efforts where I'm really focused on how do we cultivate a group of entrepreneurs and developers, apps and protocols to build these asset-backed currencies. We call them R tokens, which I know we'll get into more here on the podcast.
Yeah, interesting. So James, when you think of the word stablecoin, what practical utility most comes to mind? Because there is certainly algorithmically backed stablecoins. There's the obvious USD or other currency backed pegged stablecoins. There seems to be an inherent value in the stability of the token itself. So it can buy, 5 stable coins can buy me eggs today, 5 stable coins buy me eggs a year from now. That seems to be the value. And like what Thomas was saying, fighting inflation is like first thing in your mission statement. Where do you see the inevitability of stable coins to be the pegging of fiat currency to crypto, or is that just the first place we start? Is there some other better way to do it in the future?
Yep, it's a great question. It's really the question is how do you define a stable currency? And up till now, we've been working with what I would call the Web 0 paradigm of money, right? Unit of account, store of value, and medium of exchange. These are kind of the parameters of money over the last 2,000 or 3,000 years. But now we have this cool new thing, which is programmable money. And some things are more important than other things to certain groups of people. At Reserve, as Thomas mentioned in his intro, we are especially focused on helping people fight the effects of inflation around the world and helping them get access to stable currency. But when you bring a technology like what we're talking about to fruition, you start to get some other really interesting levers of money that are important. Safety, compounding value, security, privacy, censorship resistance, and even loyalty and branding, which most people wouldn't necessarily acknowledge that as being a part of their stable currency. But the US dollar, in fact, is probably one of the most significant memes we've ever seen in our lifetimes. And all throughout money systems, whether you're talking about Starbucks points or Robux, or Caesar's Palace chips. These are all branded forms of currency. And of course, in crypto, you have Bitcoiners and Ethereans and so forth. So I think, Mike, as we, this community of folks that we're collaborating with, everyone sort of values something different. And some of them will be pegged to the US dollar. Some of them will be what's called a flat coin, and they won't necessarily be pegged to a currency, but they will be flat over time. Or it could be pegged to something like an index. So those are some of the ways that we think about it.
And is it possible to have a stable currency such as like the one I just described there, where you can take the average consumer price index for all products and just say it's going to be pegged at, like in the case of 5 tokens per eggs, Or are we just, I mean, Thomas, I'm curious your thoughts on this. Like, how do you see technology sort of addressing the idea of stability?
Yeah, the short answer is we hope so, but we don't know. And the slightly longer answer is that, we built our protocol actually as a platform because we don't know this answer. What is the perfect backing that people should store, preserve, and even grow their wealth with? What's really interesting
I
now is
think
that
Thomas
over the
just froze
last
up.
couple of years, as more and more assets have become tokenized, it's now becoming possible where you can actually foresee a future where people can store and save their money and then spend their money all using the same unit of account that the wealthy have traditionally used to store their wealth over the long term. And so when you think about, how do the wealthy store their wealth? They use some kind of basket of stocks, bonds, real estate, commodities, cash, fiat, it's like a really truly diversified basket of funds, some kind of private equity, like the full thing, right? And it's not really, you're not storing your wealth in dollars. Very few people do that. You're not storing your wealth in just stocks. Very few people do that. It's really this diversified thing. And so with the advent of tokenization of more and more assets, you can actually envision a world where when you get paid or when you save money, it's stored in this fully diversified thing that is split up behind the scenes into, a ton of different types of things. And then over time, in theory, you can also spend your money and just slice off a very tiny portion of that. And so our hope in the long term is that we can make it so that experimentation happens, and there's lots of different flavors of this. And one of them, proves to be the best way to store your wealth. And that over time, that becomes a way that people can save, preserve, and also grow their wealth and then spend it slowly as needed.
And now, so reserve.org, it was an awesome domain, is the platform to allow other projects to launch. How many other projects? What are the top projects that stand out as being obviously successful, Thomas?
Yeah. So we launched our platform. Well, there's a little bit of a background to give as well. So we have at Reserve, there's actually two sides to the project. We have the protocol, which we've been talking about. There's also an app that is used throughout Latin America, which is what people use. There's like $300 million of monthly transaction volume and real economic activity. And it's people in 18 different countries that are using stable coins to save money, send money to their friend, pay at the store, do remittance, the full gamut of what you would use money for in the digital world. So yeah, there's that app, which is a great way for people to actually use stable currency in places where they traditionally couldn't. And then on the protocol side, like I mentioned, we launched a month ago, and our partner MobileCoin actually launched the first art token, as we call them, the first asset-backed currency. It's called USD, the electronic dollar, and it's diversified across DeFi. The backing of it is diversified across DeFi protocols and other stablecoins like USDC or Tether, which are the two largest fiat-backed stablecoins in the space, as you probably know. And what's really interesting about these stablecoin that's launched on our platform is it's self-healing and over-collateralized. And so we weren't expecting this to happen, but 2 weeks after we launched, Silicon Valley Bank had some issues, and USDC, which was previously known as the safest, definitely a dollar stablecoin, all of a sudden went down to 90, I think it was 88 or 90 cents. And so what our platform did and what the protocol did was detect that, monitor the price, automatically offload it, and then utilize the over collateralization pool in order to make up the difference. And so, in the normal course of operations, our protocol actually can get rid of bad assets and recollateralize all before the banks open on Monday. And, all before the FDIC would be able to step in and make users whole or, bring stability to the market. It was a bit of a riveting experience for us because, we had just launched this thing and it was getting tested so quickly. But it ended up being an awesome experience. And, we got to watch as the protocol automatically did all these things. And yeah, self-healed.
So say the name of that project again.
It's called the electronic dollar. And so it was launched by MobileCoin, which is another,
okay, yeah.
It's an L1 privacy focused chain that allows people to have, freely transact and not worry about, Venmo or whoever it is having ever bit of financial information about you. And so they launched a stable coin on our platform, and then they're bridging it actually from Ethereum to MobileCoin, where it can be used in in their app called Mobi. And it's, it's like digital cash that you can use around the world. And what's notable about MobileCoin is they're actually the first app that's been integrated, or the first blockchain that was integrated in the Signal messaging app. And so it's a really interesting project. We're super excited to partner with them and have them launch the first asset-backed currency in our platform. But it's also
the electronic dollar
et
is
cetera.
the first R token on the Reserve protocol. And what I'm about to say will probably initially sound crazy to people, but there might be a future where there's a long tail of stablecoins. There could be hundreds of stablecoins or thousands of stablecoins. And you might say, well, why would anyone want that? We all just would rather have a dollar. But the reason why is because when you can program in these sort of unique superpowers, like the electronic dollar on the MobileCoin blockchain, you can send it anywhere in 5 seconds for under a quarter of a penny, and it's end-to-end encrypted. It's a privacy dollar. That's a pretty cool thing. Doesn't exist anywhere else that I know about. But then you can go and build other interesting asset-backed currencies that might be pegged to $1 and might be earning a fairly high yield profile, something that can beat the rate of inflation. Good for people who want to save money. Or you could build an entirely different R token that's pegged to Ethereum with a basket of liquid staking derivatives. So it's kind of like you get access to the yield, but you don't have to do the staking part, which is pretty cool. And you have some diversification in that basket, which kind of pays homage to the old, don't put all your eggs in one basket. So those are like just a few of the possibilities. And when we really start thinking out over the next decade or two, you might see a range of use cases for different asset-backed currencies that might be pegged to $1, pegged to another currency, or pegged to some other type of index. One of the things we've seen flourish over the last many years is currencies within video games, and talk about the same phenomenon occurring in metaverses whenever metaverses truly arrive. Well, when either of those use a currency, there's a reasonably good chance that a stable currency is going to be better than a volatile currency. And none of those entities also, they don't want to be banks either. When you're a bank, you're in an entirely different business. And that's one of the really powerful things about these self-custodial, fully decentralized asset-backed currencies. We call them R tokens.
Is there, James, you think of a technical difference between a stable coin and a really large coin? Like USD is the largest currency in the world, and it happens to be one of the most stable. That's not a coincidence. Bitcoin is smaller, and so it's more volatile. Hypothetically, if Bitcoin and USD had reversed market caps, would Bitcoin just be more stable? I mean, is stability primarily a function of market cap?
Well, I think, there's a lot of predictors of what will happen to Bitcoin over the next couple of decades. And maybe once it has that sort of much deeper network effect than it does today, because mostly today it's still mostly used by speculators. It's a strong store of value. I hold some. I love Bitcoin. I've held some since, early days. But will it sort of stabilize over time? I guess we'll have to see. I'd actually be interested in Thomas's answer on this, if you want to take a stab.
Yeah, sure. I agree on all the above, and also hold some Bitcoin. The way that I think about it is, yes, markets are definitely influenced by like liquidity, right? Like how deep are the markets and how usable is that currency, right? Like, can you always convert in and out of it into something else? We saw this in 2008 when all of a sudden treasuries were actually that helpful because people couldn't get out of them, right? When they needed to actually use them to pay off debts. And so that, I'll like butcher the exact financial jargon, but basically the Fed had to step in and make it so that those things were liquid again. And they did actually seem like money. And so like at the end of the day, like as things get more liquid and people can buy and sell it and spend it, right? Then all of a sudden that does become more stable and you don't have to worry about whether or not it's going to fluctuate as much. And so like, yes, if Bitcoin was much, much, much bigger, it'd probably be more stable, but it's still pretty small. And it's still very speculative.
I was going to add the one point that I would, both of your answers seem to center around Bitcoin. James, you first mentioned the long-term unpredictable nature of Bitcoin. But I mean, replace it for any currency that's just large and ideally decentralized. So there's not a central point of decision making like the Federal Reserve to just take money out or put money into the system, which seems to be the reason, obviously, the reason why people are excited about Bitcoin is there's not a central point. James, what were you going to add?
What I was going to add is I think there's a twist on, we all come from this era of noticing power law distribution of winners and losers. But if you kind of zoom out and look at what the internet and democratization has done for entrepreneurs over the last 25 years, whether it's a media company or some other industry like e-commerce, it used to be, if it was 50 years ago, it was like, we've got to crush them all and we've got to have, 50% market share to be successful. That was considered successful. Now you have solopreneurs all over the world, even before crypto. Take crypto out of the equation. Crypto is only an enabler for more of this. But you have solopreneurs all around the world, even just using media companies, for example. I've seen hundreds of these solopreneurs build successful media companies faster than the world's largest conglomerates can. And I think this is like a pretty significant paradigm shift into the definition of success. The pandemic taught a lot of us that, actually, I don't need to go kind of work for the corporation with thousands of employees and just be almost like a number on the team. I can define where I want to live, what I want to create, and be incredibly successful for far less money than if I were doing that in New York City or Los Angeles. And I think you're going to see the same thing actually happen specifically with currencies and all throughout crypto. You no longer need to be the number one player in it. Within stablecoins specifically, you're going to see a lot of ecosystems that are only $1 billion or only $50 million. They don't need to be multi-trillion-dollar ecosystems. Now, that would be really interesting for especially whoever the so-called winner is of that. And with currency, it's a little bit more nuanced because it's also a regulated environment and that varies by jurisdiction. But this idea that you can build all of these sort of programmable currencies for different use cases and be successful at kind of what I would say is just a different size spectrum is pretty interesting for the future of currency. So you don't necessarily, the reason we've needed a global reserve currency up till now is because we had this, what I would call Web 0 paradigm for how people could exchange that currency with other currencies. But now we're moving into a world where you can exchange anything for anything. Like we're witnessing it right now happen in crypto, happen in DeFi, happening in NFTs. And we're probably, still a few decades away from that instantaneous exchange of anything, but that's what tokenization empowers. And when you move to that paradigm, you suddenly don't really need one currency to serve all. Everyone can have their own thing and you have liquidity across all of these different mediums.
So it sounds like what you're saying is that the reason you had one large currency, the reason that the world sort of arrived at that position was that the information, maybe the pricing information around all the different currencies is slow or non-transparent. And then liquidity and ability to exchange is slow or not in existence. You need the internet to be able to exchange multiple currencies across multiple countries if you're not in the same physical place. That's now, like in theory, it would be possible to not have one central large fiat currency if you had those first two conditions. You had, very transparent and accessible pricing information, and you had the ability to exchange. But that's not really the case. I mean, I don't know about you guys, but I don't do much foreign exchange trading. It just seems way more daunting than it does to even be in the world of crypto. And so, to your point, I agree with you. That seems like, and it seems like it's also riding the trend, parallel to the attention economy used to be very centralized. There used to be probably 1950s, 60s, like 2 or 3 broadcast TV stations. How many newspapers? Not that many. Now, there's millions of different, creators. which is, it's this like oscillation effect that goes from one to many and then back to one. So I agree with you. Yeah, it very much feels like we're in the space where there's a lot of different offerings, like moving away from the centralized attention and currency models. I want to ask you guys about these existent stablecoins, USDT, Circle, Tether being USDT, and USDC. Those seem to have captured not between the two of those, what would you guess? Like 90% of the market? Like it's huge. It's a lot.
Huge.
Neither one of them are transparent about where the money is. It was only until the SVB collapsed that people found out that USDC had like 5% or 3% of their money, their USD in Silicon Valley Bank, which, to Thomas's example, caused all the chaos. Why are these organizations not fully transparent? And do you see them keeping the same structure that they do? Like, or is this just a stopgap until, there's some new way that the stablecoins exist? Thomas, feel free to add.
Yeah, it's super interesting. I think, on the USDC front, I don't think anyone really realized that was a risk that they had to worry about, right? Like which bank are they keeping the money, right? Like thinking about that wasn't a risk that was on anyone's radar. And I think what it really does is, what it was a great example of is the need for diversification and the fact that over time, companies change, markets change, et cetera. But at the end of the day, like if you want something to be stable, you can't say today, this is the most stable way to do it. You need some room for adjustment and you need some room and ability to adapt. And this is actually, so a couple years, 4 years ago, we launched RSV, which was like our prototype of the R tokens that can now be launched on our platform. It doesn't have the over collateralization. The collateral can't be deployed in yield bearing assets in DeFi, but what it has is this very basic diversification. And so RSV for a very long time was just 3 different stablecoins backing it. It was backed by USDC, it was backed by the Pax dollar, it was backed by True USD. And super interestingly, over the last 6 months, there were 3 different instances where we had to change the basket that was backing this dollar. And this, for context, RSV was the unit of exchange unit of account and medium of exchange that the app side of that company has been using. And so all of the users in Latin America, many of whom barely even know it's crypto, they just care about dollars. That was the thing that was used in this app. And so what happened, when the FTX blow up happened, one of the things we were a little bit worried about it. And then, all of a sudden we switched into Binance and USDC, and all of a sudden, Binance gets shut down, and, the third largest stablecoin all of a sudden shrinks its market cap overnight. And also, goes from, I think it was like 40 billion down to it's under 10 billion now. Like things change. And so we had to do another change at that point. And, USDC depegs all of a sudden, our new stablecoin, the new stablecoin that's launched on our platform again, had to do a basket change in order to find stability. And so this, for many years, people were asking us what's the point of this? And I think the last 6 months has really demonstrated to everyone in crypto the need for diversification and the need for ability to adapt.
Why diversification? To me, your examples scream transparency, not diversification. Only 3% of USDC's value was in SVB, but that caused chaos. 3% is pretty diversified. They have 97% somewhere else. Why not just say, hey guys, this is where it all is, and have that be the solution? Wouldn't that just solve it?
Yes and no, because again, it's just the risk that was highlighted there was something that no one was predicted, right? And even if they said I think it was actually 8% was in Silicon Valley Bank. Even if they're 8% in Silicon Valley Bank, 20% in Prime Trust, whatever the different banks were, right? That you still don't no one was really predicting this banking crisis. There were some people, right? But general crypto and general USDC users were predicting this. And so what it really does is it just minimizes downside risk for the individuals. And so when we think of EUSD, the R token that's currently live, even though USDC went down 10%, since it was only half of the basket backing USD, USD only lost 5% of value, right? And so that's where the benefits of diversification come in, is it just minimizes downside risk of individual actors having problems. And so in this world where you're relying on these different companies with different types of transparency and different types of operations and different types of risks, it's just helpful to diversify that risk. And so like in this particular instance, it was helpful for people that were holding the USD. The users didn't have to worry about it because of the diversification and that over collateralization. And then, by the way, anyone that holds or integrates with the USD on their app, they also don't have to swap that out in the time of crisis. They just know that behind the scenes, this stuff is happening. And so it's almost like a user-friendly wrapper, right? Like if someone's holding USDC, they can rely on the protocol to do the automatic stuff, and they can just know that their thing is going to be worth $1 and not have to worry about where the stuff's held, what's backing it, et cetera.
Mike, you used a really interesting term, stopgap, with these current stable coins. So yeah, USDC and Tether are something like 90 to 95% market share of the entire stablecoin space. I would say we are currently in the America Online stage of stablecoins. We're about 1994, 1995 right now. And, for the internet, invented in 1969, there were a couple of really interesting turning points. One was the World Wide Web moment in 93. The next big one, other than the dot-com bubble crashing around 99, 2000, was the broadband moment, which happened in the early 2000s. And that's when we got Netflix and, Facebook and stuff like that. And then kind of the next big moment was the iPhone moment, so to speak, around 2008 and 2009. Each of these moments transformed the use of the medium. And I remember in the 90s, I was working with forensic accountants. I was at a law firm, just kind of starting my career. And they all thought Amazon was a fraud in 1999. They thought this company's going out of business for sure. It's not going to last. And then dot-com bubble burst and the stock dropped from like $70 a share down to 70 cents a share. It's just like these cycles that we go through with crypto when everyone says crypto's dead. That's what they did with Amazon. And then, then we get like, oh, wow, Amazon is now into the web services business and now a multi-trillion-dollar company. So I hate to be so cliche and say we're early, but the way we've understood stablecoins up till now have been working with the constraints of up till now. And certainly if any of us were sitting around in the mid 90s, we might not have thought that there would be an app for getting an Uber or some kind of app like Instagram or Netflix or these types of things. It's so hard to contemplate what that could be because you haven't seen it yet. But that to me is one of the interesting possibilities when we think about the design space for stablecoins and this idea of all these different kinds of programmability. Again, depending on what's important to people, is it security or privacy or speed or pegged to a certain basket of assets, maybe a basket of eggs and bread and, other things that we like to eat. Yeah, and this is the exciting part about being a permissionless platform. As Thomas mentioned earlier, we don't exactly know how it's going to be used. But when you have a community of entrepreneurs experimenting with it and using it for free to use, you get some really interesting outcomes there.
I love the background, James. Do you agree that USDT and USDC had not been transparent? Maybe they're more now, but they hadn't said, here's the 17 accounts where we have it. Here's the external auditing firm providing weekly updates. Like USDT is notoriously vague, right? They're like, oh, don't worry, we got it somewhere. And like, I think that's what gave rise to USDC. But even then, like, why is there not someone out there that's like, here, we have it all in one bank account, and here's the bank itself saying they have it, and they're keeping it in dollars. Like, if you held USDC, you're actually holding it across a variety of banks, and you're probably owning treasuries because the bank is taking your money, like a hedge fund, and they're reinvesting it. So there's like it's like the same thing as FTX. Like, you think it's here, but they moved it over here, and then they bought some other shit. And like, why do you think? I mean, I'm coming at this from the perspective that, yeah, diversification is great if you have transparency, but without transparency, you don't even know what you're investing in that you could even be diverse. James, do you see any projects being very transparent in this way or know why they wouldn't be?
Yeah. Well, I think you framed it correctly. Tether was first mover and they got away with not very much transparency at all for a long time. Although they're trending in a new direction because USDC is eating their market share. USDC came out as a second mover and they really emphasized this transparency. But I think another one of these levers of programmability is around proof of reserves on chain, where anyone can go and look at what are the assets backing the so-called currency. And where this is important is, if you had this in the Silicon Valley bank run, you'd have really, I think, two really valuable tools for users and for consumers. One is you're able to now put your money where your values are. You can choose institutions or protocols that are utilizing the money in the way that aligns with what you would like them to do. Like, for example, maybe if we all knew that the bank had put their money into 10-year treasuries, we might, someone would have sounded a red flag a lot sooner had that been disclosed transparently. That's pretty powerful. You have this is one of the cool things about crypto. You have armchair sleuths solving big frauds before traditional law enforcement do. The second thing is once you can actually see everything transparently on chain, there's really no reason for a social media fueled bank run, which is pretty cool, right? Without the truth, we're left to nothing but fear, uncertainty, and doubt. And that makes people crazy. And now we're in this new era where information travels so fast. But, I think it'd be cool. Thomas has done a lot of thinking around proof of reserves and how we approach it and how we see the space is almost like a default of how the future financial system should work. Thomas, I think it'd be cool if you could speak to that for a minute.
Yeah. Also, Thomas, please do. Also, I'd love to learn how you guys make money, what the business model is, where you guys as an organization or whatever you call it are incentivized to do.
Sure. Yeah, I can take both those. I think James talked a lot about this, but one of the things that was most exciting to me about crypto over the last year, and DeFi in particular, is that as there was all these different lending crises fueled by, it was kind of initially fueled by Terra collapsing. And then everyone else figured out, okay, so if Terra collapsed, who was really exposed? And then all these different non-transparent lending agreements and under collateralized loans came out, and one by one, more and more different things were exposed on who had exposure to this, and it kind of all ended up being FTX at the end of the day, and let's not go into that, but at the end of the day, no one really knew that all this debt was owned by FTX, right? And what was really fun to see, besides everyone losing all their money, what was really exciting to see was the DeFi protocols like Aave, like Compound, where people can lend money and borrow money there, but everyone knows exactly how much is owed and where it is. And, it might be a pseudonym of a wallet address. But those lending protocols operated without any issues, even when Bitcoin fell by 70%, Ethereum fell by 70%. And these are all collateralized positions. The auctions functioned without any issues, and the protocols themselves were totally solvent. And so that to me was a really magical moment, and it really improved the lendiness of these protocols and this transparent proof of reserves. And so it's one of the reasons that we're super excited to build on top of those things and expose those primitives as the backup to these currencies, right? Instead of holding the funds in a bank, they're being lent out on these super transparent transparent DeFi protocols, where that yield is being generated. It's like real economic activity that's generating that yield. People are borrowing it, but that automatically people will be liquidated if they borrow too much or if their collateral goes down or whatever that is. And to me, that's really magic. Transitioning now to reserve. So we talked about it a bit, but just to spell this out in more detail of how the protocol works and how EUSD in particular functions as an example. So EUSD, the electronic dollar, is an R token that was launched in the platform. It's backed by 25% USDC that's in Aave, 25% USDC that's being lent out on Compound, and then Tether, 25% in Aave, 25% in Compound. And so the underlying collateral for this stablecoin is actually earning yield, and it's around 3% on average across those four things. That yield is then actually shared and sent to an over collateralization pool, which is our governance token, RSR. People can choose to stake it in that over collateralization pool. And in the case of a default, like what happened with USDC, that pool is sold off to make up the difference. But in good times, when there's no default, then they get the yield from all of the underlying, and the protocol calculates how much that yield is and sends it over to them. And so they accumulate yield. And so basically, these people can choose to put up capital in exchange for them making the decisions on what the backing should be. And they get paid with the revenue. But they, in the case of any issues, they're the first capital at loss. They're the first ones that pay for any mistakes that are made. And so we think that that incentive alignment is really important. And so long way around, how do we make money? We have company governance tokens and we stake them on USD, and we plan to stake them on our tokens as well that launch. And so, participate in governance along with the community. And so our business model is, the higher the market cap of these stable coins or these R tokens that might be, like a slight tweak on a stable coin, like James was saying, it might be like a yield bearing dollar, or it might be a diversified ETH portfolio, or it could be, like a diversified basket of goods like Bitcoin and Ethereum and some dollars and some other things and commodities that people just want like a new way to store their wealth, almost not an ETF, but kind of similar to how an ETF would give people diversification across a variety of different asset classes. And so as the market caps of those things are higher, there's more yield being generated by the underlying that will go to these different staked RSR pools, and we'll have our RSR staked in those pools, and we'll be getting revenue from that. So it's actually similar to how Circle is like a really, really, really simple business model. The higher the market cap, the more they can have in treasuries, the more yield they get from the underlying. Ours is very simple as well. We don't have as good of margins as Circle because, treasuries are printing at like 5% right now, right? So there's less margin for us. It'll be much lower depending on how much we stake in those pools. But yeah, it's a very simple business model. The higher the market cap, the more the collateral generates revenue and the more that we can participate in it.
Interesting. How does Circle's model work? It's very simple. Do they take money in from people and then do they just lend it out to the government in exchange for treasuries?
Yeah, more or less. So they take there's like a $40 billion market cap. They invest, I believe it's like 95% of it is invested in short-term treasuries. And which is, like you mentioned, it's a loan to the government. And so they just get whatever that short-term treasury rate is their revenue, multiplied by the market cap. And then the rest of it, they hold in cash in case people withdraw and need to convert USDC into fiat. That's when they'll just, they'll use.
James, give me like I have. So Thomas just explained the model, which is you are, as a company, you're a leading contributor to the decentralized protocol. You guys each own some of these tokens, these reserve tokens. As more people want them, the value of the tokens goes up, presumably. And then, am I right? Okay, I'm slightly off on that. The interest rate that's paid out on these tokens increases.
Yeah, well, the market cap. Yeah. Like the more people deposit into the protocol, the higher the market cap. The assets themselves may or may not appreciate whether or not it's yield bearing. Like USD, for instance, doesn't appreciate. So that's just from people depositing funds in because they want this over collateralization, this diversification, and this easy to use format. But there might be one that's like, partially backed by Ethereum or things like that, where the price could change. There's some nuance there. I just want to make sure that there's no confusion that like USD will be going up in price or anything like that. That should actually stay at $1.
Right. And as a company or as a protocol company, is Reserve moving money out and taking the same strategy as Circle? You're not buying treasuries, are you?
It's all deployed in DeFi. And so like USD. Got it. Yeah, and we don't do the deploying. What Reserve did is we built this platform that allows anyone to define how these stablecoins should work or how these R tokens should work. And so then once someone launches one of these things, which is like the definition of how it should work, then anyone can come and mint and redeem it by just bringing the collateral that is the defined backing and depositing it and then getting the R token in exchange, or vice versa, bringing the R token and giving it to the protocol and then getting the backing as an exchange. And so that one-to-one redeemability is really important. It's a much safer design than an algorithmic stablecoin, for instance, which doesn't have that one-to-one backing.
Yeah, that makes a lot of sense. James, what makes a great head of ecosystem? Like when you talk to other people who are doing it very well or not so well, what stands out to you as people effectively working for a private company trying to grow the market cap or value of a decentralized protocol? What have you
My
learned?
first answer is I want to meet that great head of ecosystem. I'd like to learn more from him or her. Let's build a bigger community. But I was having a conversation with someone about this morning about intrinsic motivation versus extrinsic motivation, and I think this is a phenomenon we're really observing happening in crypto right now. I kind of came up in the old world. There's consultants and people who say, here's my proposal and you'll pay me X. And maybe the engagement goes well, maybe it doesn't. Sometimes they do, sometimes they don't. And it's very much, it was kind of this old paradigm of here's my resume and all of my cool looking credentials. But now we're like in this new era where still some of that matters, but increasingly, and these are like the kind of people, in fact, we're hiring, we're looking for a few folks to join the ecosystem team. We're looking for people who are missionaries, not mercenaries. And you see this a lot in crypto. People are diving into DeFi protocols to learn them because they're excited about it. It's the same reason that I bought Bitcoin in 2013. I didn't buy it because I thought it would go up. I had no idea. I didn't even understand the white paper. I bought it because I wanted to learn it. I thought this seems really interesting. And there's a couple of people I respect that also believe it's interesting. And it's been a teaching mechanism for me. Same way when I got interested in Ethereum. And by the way, same reason why I invested in Reserve Protocol. I wanted to learn about stablecoins. I was like, this is a good way. When you put some skin in the game, your learning curve accelerates quickly. So, back to your question on what makes a good head of ecosystem or people that are building ecosystems, I think it's finding people who are they're going to go down this path with or without you, right? They're intrinsically motivated to learn a lot about stablecoins, learn a lot about building a movement. And those are the types of people that I look for because they're the ones who are going to endure even long after I'm gone. That's the kind of team that we're trying to build at Reserve and the type of people that I'm looking for. But, on your point on heads of ecosystem, I'm actually looking at building like a small micro community of 10 or 20 heads of ecosystem, kind of at the same level of size as Reserve Protocol. So we can all learn from each other and figure out what's working best or not. Is it hackathons? Is it some other type of community sort of execution together? Or is there some type of intrinsic incentives versus extrinsic? We're all learning this in real time. And a lot of the things that were popular 12 months ago are really not that useful and relevant now. The space is moving so quickly. Like I said earlier, we're kind of like in the AOL era of stablecoins. I see the same thing happening actually in growing communities within Web3. Like one of the areas that Thomas and I are especially focused on is attribution. What's working and what's not? How do we track that? It's been done for more than a decade in Web2. It's just barely beginning to start to vibrate within Web3 and crypto.
That's super interesting. I've been organizing, I've done a lot of these podcasts, and I've started to organize people that have really particular interests, growing an ecosystem of decentralized protocol. It's like, that wasn't on your, it wasn't in your career trajectory 20 years ago. It didn't exist. And so I've organized a few of these calls, and I've talked to a number of people. Like I interviewed the CEO of MobileCoin, but also a bunch of other head of communities at these protocols. And for instance, one thing that came out that was surprising was one of them told me, in the foundation, we have grants, and we use part of the grant to give out to developers to build on the platform, build on the protocol. Sounds great, right? You have some proposal out there, or they submit proposals, and then you make a decision in the foundation, give out the money. Well, there's a large number of people that are applying to all the different foundations, and they're receiving a lot of grants, and then they're not doing anything. And so that approach, basically just doesn't seem to work across the board. Like I haven't talked to any head of ecosystem protocol that, maybe one or two examples here and there, but overall it's like unprofitable endeavor. And I wonder how many are out there still doing that. And if there's a way to make it profitable for the protocol, it's like a very nuanced insider conversation that I'm sure you have takes on and insight to or experience with, that would be super interesting to like contrast it with other protocols and hear their experiences and what they're doing. Because it's not like competitors getting together discussing what marketing strategies work. It's like your success actually makes it in like a real genuine way. Companies will often say like, oh, I want the best for my competitors, but it's all kind of like not actually true. But here it's actually legitimately true. Like you want other token projects to work, given that it's so, maybe that changes one day, but for the most part. So It's awesome to hear that you're doing that, and interesting to hear. I'm curious to hear how it goes.
Sure. And on that note, on competitors, I mean, the real competitor is the current broken financial system.
Totally.
It's not other stablecoin projects as far as I'm concerned. There's a couple of folks in the space who talk about positive sum collaboration, not zero sum. I'm a big believer in that. We're so early. Us fighting over small little fiefdoms within crypto is not a good use of time. Meanwhile, there's this multi-trillion-dollar landscape that is broken and underserving people all around the world. You've seen people robbing the banks in Lebanon to get their money out. You've seen riots in the streets in Nigeria because they're printing a new form of money that the people don't trust. Places where we started in Venezuela and Argentina, people that just want to preserve their spending power. Those are the systems that are broken, and that's where the real opportunity is. So I'd love to collaborate with you or anyone in your network that wants to share those practices so we can learn and grow together.
Yeah, awesome. Well, I'm super interested to see how this all goes, because I saw a stat recently that was said there was five major global reserve currencies in the last 600 years since 1490. I think it was Portugal, Spain, the Dutch, British, American, somewhere about that. And on average, they're 94 years long. And the US is on year 99 of its global reserve currency status. And so the kind of consensus is like, yeah, the US is going to lose it at some point, but to who and how does it go down? We don't want it to be China. The US doesn't want it to be Bitcoin. There's this rising tension between states within the United States that are like Florida and Texas and Wyoming. They're like, we have DAO laws. We're like a Bitcoin sanctuary state. And so it seems like now's the time to prepare for that increased tension, particularly between US and BTC, to have an escape route, to have a place that people can go if and when the USD global currency, decreases in influence.
There was a really awesome part of this too for governments, right? America made itself based on open markets and experimentation and innovation, creativity, entrepreneurs. And when you let entrepreneurs go out and try something 1,000 different ways, the whole system moves much faster. Yes, there's going to be some failures. There's going to be some fraud. Frauds have been going on though for thousands of years. They'll probably go on for several thousand more. Crypto's not going to stop fraud. Make it better to easier to track though. It seems like that's working. But when you let free markets experiment with these technologies, this is really an opportunity for the US government and other governments around the world to let free markets do their work, to find the parts that are going to work and find the parts that are going to break. And, maybe they will be able to solve the innovator's dilemma themselves. You mentioned kind of the 5 global reserve currencies over that period of time. None of them made the jump to bridging to the next era and sustaining on. I would prefer not to go through any period of apocalypse or, some of the conversations that are happening. I think we would all enjoy stability and being able to buy eggs. And, the pandemic was pretty annoying at the very least and terrible in other parts of it. So letting the free market experiment with these things in a smart way, I think is really something that can work for governments. And it's interesting to see even though in the United States, regulators don't seem to be kind of coming to the table transparently. Meanwhile, in Europe, they are. In Dubai, they are. In Singapore, they are. Even in the UK, it's like, okay, there's like a new revolutionary war, but it's not being fought on a battlefield. Like the UK is moving ahead on stablecoin regulation faster than the United States. So these are just super interesting things to watch. I'm a little bummed of what's happening right now in the United States, but I'm hopeful that the political process will do its work.
The next America is the internet, and you guys are leaning in. Like, embrace where it's happening. Guys, I want to be respectful of your time. Do either of you guys want to give a shout out to where you are writing or tweeting or blogging personally? We'll have all the company links in the show notes.
Yeah, sure. At Twitter, I'm Mattimmost, which is like Mattimore, but a little bit more. MATGI questioning.
Nice. And James, are you?
I'm 0xGMG on Twitter. And then you can follow a lot of cool stuff at the Reserve Protocol, at Reserve Protocol on Twitter.
Awesome. Well, thank you guys so much and wish you the best of luck.
Thanks, Mike.
Thanks, Mike.